Hello, I'm Radhika Shah from BDO FMA, and I'm here to offer some information in this presentation on understanding audited financial statements. A nonprofit's financial statements provide lots of information about its financial health and performance, but only if you know how to read and understand that information. Of course, many of us in the nonprofit sector, as staff members or board members, or even funders or donors, don't necessarily come with a background in accounting or finance. And even those of us who might be familiar with financial statements may not be that familiar with nonprofit financial statements, which, as we'll see, are different in many ways from for-profit financial reporting. So what I'm going to do in this presentation is walk through a set of nonprofit financial statements and give some tips about what to look for when we are reading and understanding them. A nonprofit audit is one of several places where an organization's financial data must be presented according to GAAP, or Generally Accepted Accounting Principles, a common set of accounting rules to keep financial reporting consistent from one organization to the next. GAAP standards for a nonprofit audit require 4 financial statements, and in this order. First, we have the Statement of Financial Position. This is also known in the for-profit or corporate sector as the balance sheet, and we typically refer to it even in the nonprofit sector as the balance sheet. Next, we have the Statement of Activities, which is known in the corporate sector as the income statement or the profit and loss, the P&L. Next, we have the Statement of Functional Expenses. This is not known as anything in the corporate sector because there is no equivalent of the Statement of Functional Expenses in a for-profit audit. However, nonprofit organizations are required to report expenses by function and nature, which we'll look at a little more closely in a bit. Finally, we have the Statement of Cash Flows, which is also known in the for-profit sector as the Statement of Cash Flows. So we at least have agreement on one of the 4. And then following the basic financial statements themselves is a set of notes to the financial statements, and we'll talk a little bit about what is included in those notes. So now what I'm going to do is walk through each of these 4 financial statements, beginning with the Statement of Financial Position. So the Statement of Financial Position, or the balance sheet, consists of 3 components. We have assets, liabilities, and net assets. So our assets are simply what we own as an organization, including cash receivables, investments, property, equipment. Anything that we own as an organization is an asset on our balance sheet. Liabilities are what we owe to parties outside the organization. So this is bills due, a line of credit, any debt, mortgages, anything like that is a liability on the balance sheet. And the difference between assets and liabilities are called net assets. You might think of net assets as the net worth of an organization. In the same way, you might consider the net worth if we were looking at our personal or individual finances. The difference between our assets and liabilities would be our net worth. In the corporate sector, this is called equity or shareholders' equity. The difference between assets and liabilities in the nonprofit sector are called net assets. As we will see, there are different categories of net assets in the nonprofit sector, without donor restrictions and with donor restrictions. And we'll talk about that difference. So what I'm going to do now is actually move to an example of a balance sheet. This is a sample hypothetical set of nonprofit financial statements for an organization that we've made up. And this is what the statement of financial position or the balance sheet looks like for this organization. So we'll walk through it quickly. The first section of the balance sheet is the organization's assets. So this is where we see the assets, and you see different categories of assets. So we have cash, grants and contracts receivables, accounts receivables, and so on. When I'm looking at a nonprofit balance sheet, one of the first places I look at is cash. You might have heard the expression cash is king, and we have to have cash in order to pay our expenses. So it's important to keep an eye on the organization's cash position and to think about what that cash position is relative to the organization's expenses. The next section of the balance sheet is the liabilities. So liabilities, again, are things that we owe to others. These are our accounts payable, accrued expenses, if we have loans, bank loans, lines of credit, mortgage, all of that will appear in the liability section. Now, the difference between assets and liabilities, like I said before, are what we in the nonprofit sector call net assets. So this organization has a little over $1 million in assets, 200,000 in liabilities, and so the organization's total net assets, as you will see in the left-hand column, is $821,000. Now, like I said, in the nonprofit sector, this will be a recurring theme of this presentation. In the nonprofit sector, things are a little bit more complicated when we're looking at financials. So, although the difference between assets and liabilities is net assets, total net assets, there are a few different flavors of net assets as we'll see in this organization's financials. So net assets in nonprofit financials are broken down into two different classifications. We have net assets without donor restrictions, and we have net assets with donor restrictions. Let's start with net assets with donor restrictions. Restricted net assets result from revenue which donors have limited relative to use. Only donors can restrict revenue by placing some criteria around it. For example, if we have a grant from a foundation for a particular program, that money is restricted until we spend it on the program that the grant is funding. So a restricted net asset is a contribution that we've been given which a donor has restricted for a particular time or purpose. Once it's used for that purpose or within that time period, the restriction is then satisfied. Some organizations have net assets restricted in perpetuity, frequently called permanent endowments. These are generally structured as income-generated investments. These contributions usually cannot be used at all, and the restrictions usually do not expire. So we can typically invest those assets in accordance with the endowment policy and use the related investment income. Organizations with permanent endowments can show a further breakout of the various nature of restrictions under the net assets with donor restrictions category. Net assets without donor restrictions are those that the board and management of an organization can use at their discretion. So a donor has not said you have to use this contribution in a particular way. It's up to us how we use it. Some organizations may have board-designated assets where the board earmarks a portion of net assets without donor restrictions for a particular purpose, like future capital projects or other potential investments. While the board may have placed requirements on management in order to access those assets, they're still not considered restricted from an accounting perspective. Since remember, only the donor can restrict revenue. Therefore, board designated net assets can be shown as a subset of net assets without donor restrictions. So those are the different net asset categories that you'll see in an audited financial statement. What we are looking at are our total net assets without donor restrictions. So the $244,000 of net assets with donor restrictions are again nice to have, but they are basically spoken for. They have to be used in a particular way based on the donor's restrictions. What we actually have discretion over are our net assets without donor restrictions. Once again, it gets even a little more complicated. A key metric to look for on our balance sheet is our liquid unrestricted net assets. Our total net assets without donor restrictions or unrestricted net assets include if the value of any property or equipment we own, like if we were to own a building, for example. A building is certainly nice to have, but the value of a building doesn't necessarily help when it's time to make a payment or pay a bill or make payroll because we can't easily convert that type of fixed asset into cash. So what we pay a lot of attention to on the balance sheet is our liquid unrestricted net asset position. And you'll see on the screen another term that we at BDO FMA use for this is LUNA. So when we think in terms of our financial reserves, we're really talking about our LUNA, our liquid unrestricted net asset number. This is an organization's level of true reserves, the money that it can tap into to pay expenses, to use for working capital, to invest in new programs or opportunities, to weather potential downturns. That does not include the value of fixed assets like our building or our property. If we have positive LUNA, that is our reserve position. Those are the assets that we have available to cover operating expenses, provide working capital, and so on. If we have negative LUNA, and that's actually possible, and we'll talk about and look at that in a moment, that indicates that we have actually borrowed from restricted funds or from external sources in order to pay for our expenses. And that shows a lack of financial flexibility. Not many reserves, or really no reserves at all if we have a negative LUNA position. So looking back at the balance sheet, in order to figure out what is our actual reserve position, what is our liquid unrestricted net asset number, we begin with our unrestricted net assets, which again in this most recent year is $577,000. But if we look back up to the balance sheet at our assets, we will see that included in that is $625,000 in property and equipment. So that's fixed assets. That is illiquid. What that leaves us with is actually a negative number. So in terms of LUNA, we actually have a negative 48,000 liquid unrestricted net asset position. Now, you'll see in this balance sheet, it's actually broken out for us separately. We don't see this presentation often, but it's interesting because that gives us an immediate indicator of our financial health, our financial flexibility. What is our reserve position? You'll see in this case, when we subtract out the value of our fixed assets from our total net assets without donor restrictions, we'll see that we've actually dipped into the negative, which means that we have drawn from, in this case, probably net assets with donor restriction in order to finance our operations. That can be a challenge. That can be a challenging place to be in financially. So the next statement that we're going to talk about is the statement of activities, also called the P&L, profit and loss, or the income statement. The balance sheet that we just looked at is as of one particular point in time. So if I go back to the previous slide, you'll see that this is as of June 30th. This is what our assets and liabilities and net assets looked like as of June 30th. The statement of activities shows us our financial performance over the course of a period of time. Audited financial statements generally cover one fiscal year, but not always. Be sure to check the period being reported when reviewing audited financials. So the audit tells us over the course of the accounting period what our revenues looked like by type and by restrictions, what our expenses looked like broken out functionally. We'll talk about what that means in a moment, and what our operating results were. What was our gain or loss, our profit or loss for the year? So now we'll go through a statement of activities, an income statement for this same hypothetical organization. And you'll see there are a few different columns on the statement of activities. We have our without donor restrictions column. This shows us our revenues that were generated on an unrestricted basis for the year being reported. So again, that's revenue that we could use to fund operations in that period. The statement also shows our expenses for the year, and you'll see that the expenses are broken out into program services, management in general, and development. It is required of GAAP financial statements or GAAP financial presentations that our expenses are broken out into these three organizational functions on the statement of activities. So if you have heard of things like ratio analyses or efficiency ratios, things like that have to do with the percentage of your spending that go into these different categories. So your program percentage, your management and general percentage, your development percentage. These dollars are shown here. And you'll notice all expenses appear in the without donor restrictions column. The next column on the statement of activities is the with donor restrictions column. That shows us restricted revenue that we've generated but haven't used yet. It might be restricted for a particular time period. It might be a multi-year grant that some of the funds are restricted for future years. It might be a grant related to a program, but we haven't executed yet, or we haven't completed the program yet. So those funds have not yet been released. So that with donor restriction column shows us revenue that was raised or released that year on a restricted basis. So what does it mean to release restricted revenue? Deductions from the with donor restrictions column come in the form of releases. So you'll notice this organization had $272,000 released from donor restriction and moved into the without donor restriction. So this net asset released from restriction line will always balance, will always total to zero. Because once we use our restricted assets for the purpose that they were designated, we can then move that asset from restricted into the unrestricted column. So that's what's going on in this line. And you'll notice in the with donor restriction column, there are no expenses. Remember, donors restrict revenue, not the expenses. So we have our without donor restrictions column that shows us revenue that was generated on an unrestricted basis and expenses. We have our with donor restrictions column, which shows us revenue that was generated on a restricted basis, as well as releases to unrestricted. And then we have our total column, which shows us our overall change in net assets. But the total column can be misleading from an annual operating result perspective because it combines revenue without donor restriction or unrestricted revenue with donor restrictions or restricted revenue. So again, unrestricted revenue is revenue that was available for us to use during that fiscal year. Restricted revenue is revenue we raised, but it's not yet available for our use because it is still designated for some future purpose or a future time period. So the total column brings those two things together. So when we're actually looking at GAAP financial statements to understand what happened, the without donor restrictions column is where we want to look. That's where the action is. So the number to look at on the statement of activities for our operating results for the year is the change in net assets in the without donor restrictions column. The change in net assets on an unrestricted basis is our true operating results for the year. That's our bottom line, even though, as you will notice, it does not appear on the bottom line in the statement of activities. That is still our operating result for the year. So you'll notice in this case, our operating result was a deficit of $111,000. Now again, I just want to contrast that with if we had looked at our total change in net asset line. In total, it looks like an $11,000 surplus, but that's not the reality of what our operating result was for the year. So that's why looking at the total column can be a bit confusing. What we want to pay attention to is our change in net assets in the without donor restriction column that shows us that this organization ran an operating deficit. The next financial statement that we're going to talk about is the statement of functional expenses. GAAP requires all nonprofits to report expenses by nature and function in the statement of activities, in a separate statement like we see here, or in the notes to the financial statements. Like I said, this is not a statement with an equivalent in the for-profit financial statements. The statement of functional expenses shows us how we utilized our resources over the course of the year in both functional expense areas and natural expense areas. So the statement is set up as a matrix. It categorizes our expenses as programmatic, administrative, or fundraising related, and it often breaks down programmatic expenses by individual programs. So remember, we have to show a program, administrative, and fundraising breakdown of expenses on the statement of activities. What the statement of functional expenses does is breaks that down even further. Let's take a look at an example of a statement of functional expenses. Apologies for the small numbers here. So you'll see that the statement of functional expenses has columns for each program. In this case, 3 programs, program A, B, and C. And we can see from this which is the organization's largest program. Program A has a total expense for the year of $823,000. Program B is $425,000, and Program C is the smallest at $170,000. We also see how much the organization has spent in administration, also known as management in general, as well as in fundraising, and then in total. We also see natural expense categories. So those are the rows. We've looked at the columns that show the functional expenses. The rows show each of the natural expense areas. So salaries, benefits, taxes, fees, occupancy, and so on. All of the different costs associated with running the organization. So you can quickly use this financial statement to do some expense analyses to understand what are the biggest drivers of expense for the organization. Of course, in almost all cases, the biggest drivers of expenses for nonprofit organizations are personnel related. So we can see what the total personnel costs associated with this year's operations were. And then what I typically do with a statement of functional expenses is just scan it to try and understand the other primary cost drivers for the organization. So in this case, professional fees, supplies, and depreciation expense is significant. You'll also notice lines like telephone, for example. Now, we have a total expense there of about $32,000, and that is spread across the different programs and functions of the organization. It's most likely not that each program has its own telephone bill. That's not typically how things work. What's happening there is costs are being allocated across functions. The organization comes up with an allocation strategy or an allocation methodology to share expenses like telephone, depreciation, insurance, and interest across the different programs and functions that benefit from those items. Ideally, your organization should actually be budgeting on this basis as well. So you'll want to think about your budget in terms of both natural and functional expenses. There's a tool called the Nonprofit Budget Template that will help you budget your organization's expenses on a functional basis. The way it looks is very similar to a statement of functional expenses. That tool can be found on the budgeting tab of the strongnonprofits.org website that's hosting this video about audited financial statements. The final financial statement that we'll be looking at is the statement of cash flows. Now, the first thing to note is that the statement of cash flows is not the same thing as cash flow projections. The statement of cash flow actually looks back at the previous year and shows where our cash came from and how it was used. It's not the same as a cash flow projection, which is a forward-looking financial document that projects cash coming in and cash going out over the course of the coming months or weeks. The statement of cash flows is a backward-looking statement that covers what happened over the course of the past period, the past year in this case. If you're applying for a loan or a line of credit, the statement of cash flows will get some scrutiny from your lender. But from a day-to-day financial management perspective, a forward-looking cash projection is likely a more effective planning tool. So here's what a statement of cash flow looks like. It reports on cash coming in and cash going out from your operations. So there is a section of cash flows from operating activities, from investments and investing activities, including investments in fixed assets, and finally from financing activities. So if you've taken out loans, repaid loans, that will be reflected here. If I were looking for one particular number on the statement of cash flows to pay particular attention to, I would probably look here at the net cash provided by operating activities. So that shows us, on a cash basis, if our operations generated sufficient cash to fully fund the operations themselves. So we like to see a positive number here. We like to see that we were able to generate enough cash to fund our operations. The caveat here is that the cash flow statement is based on our total change in net assets, not on just our unrestricted number. That's one of the limitations of the cash flow statement for nonprofit organizations. So, although we definitely want that number to be positive, we can't tell from the statement of cash flows alone if any of the cash generated by operations are part of our restricted net assets. Finally, at the end of the audit, there are typically several pages of notes containing important information, often referenced in the financial statements themselves. So sometimes you'll see on the balance sheet a value for fixed assets, and it will say, see Note 6, for example. Notes to the financial statements provide lots of important disclosures and clarifications, and they should be reviewed as well for information about the organization's financial position and financial activities. They include things like a description of the organization itself, the basis of accounting the organization uses. There's usually information about the different types and values of fixed assets and how much depreciation has accumulated on those assets over the years. If the organization has debt, there's information about the type of debt, the repayment terms, If the organization has net assets, there's the description of those and a schedule for how much the assets are and what they can be used for. Subsequent events. If anything has actually happened between the end of the fiscal year and the time that the financial statements were issued, which is typically a few months later, there will be a disclosure about if there was some financially significant event that happened in that period. It will be included in that footnote as well, anything around commitments and contingencies, significant financial concerns that the auditor and the organization feel should be disclosed, like if there's a significant concentration of the organization's revenue within one source, or concerns about the organization's financial position. Those must be reflected in the notes to the financial statement. So that was a quick tour through audited financial statements for nonprofit organizations, what to look out for, how to read and understand them. I hope it's been useful. Please be sure to take advantage of the other valuable resources on strongnonprofits.org, a comprehensive set of financial management tools and resources developed by the Wallace Foundation and BDO FMA.